Welcome to Mex Moves, the weekly podcast where Damien Fraser and I, Eduardo Garcia, break down the topics and headlines driving Mexico's key business and finance stories. How are you today, Damien?
Very well, Eduardo.
Great to hear that. This week we have two very good interviews. One with Bernardo Cordero. He's a partner at VC firm Nascent and co-founder of Mexico's Tech Week, which is a long week reunion, panels, networking event that will take place next week here in Mexico City. So he has a lot to tell us about that. And second, we also talk to Pedro Latapi, CEO of HR Ratings, the largest rating agency in Mexico and fast-growing rating agency in the United States, to assess some of the activities that rating agencies do and how they are viewing their industry, the markets, the economies, and the companies that they cover. We also will be visiting the new tax proposals regarding transactions through platforms that it's been implemented through the budget that will be approved in the next few days or has been approved here in Mexico. We'll also talk about Orbia selling a very important subsidiary, or rumors say that it will. We'll also talk about the sizes of the AFORES, how much they've grown here in Mexico. Those are the pension private companies. A little bit about foreign intervention or foreign participation, may I say so, in the Mexican stock market, and a few snippets here and there. So, Damien, you were going to talk about this new tax proposal that's been implemented in Mexico regarding transactions on platforms, on online platforms.
That's right, Eduardo. So as some of the listeners might have read or might have seen or might even be involved in, the government in the budget has proposed new tax withholdings for digital platforms, e-commerce platforms like Amazon and Mercado Libre, which are going to be specifically targeted at their marketplaces when they operate for third-party sellers, which is the dominant total gross merchandise value, by far more than 90% at Mercado Libre and also the majority at Amazon, although a little bit less relevant compared to Mercado Libre. The retention for income tax apparently is going to be if it goes through as proposed, and obviously there may be changes, 2.5% of sales, and then VAT retention, it's going to be 8%, which is half of the actual VAT. Now these are withholdings, so the seller can then use that tax as credit against his tax owed. But it's created quite a storm in the press, and Mercado Libre has taken quite an unusual step, having putting out a sort of press release against this initiative. And this is the company that Gabriel, the founder and CEO for the moment, was with the president recently in the Mañanera, and they're investing a lot in Mexico. They're clearly the largest e-commerce player here, and they've been pretty upfront. The sort of in the Mercado Libre press release, the sort of the argument, which is well laid out as you'd expect from a company as sophisticated as Mercado Libre, is that the online sellers on their marketplace, they operate on very tight margins, usually according to them 2 to 5% after costs such as shipping, packaging, and fees. And so if you're withholding 2.5% for income tax and 8% for VAT, it's going to have a significant impact on cash flow, as they're going to basically lose money under these projections on each sale, and then have to claim back the tax. And of course, it can take forever to get tax back from the Mexican authorities, and sometimes you don't get it back. So an example would be if a seller earns 100,000 pesos in monthly sales with a 5% margin, he would obviously get 5% profit, 5,000 peso profit, but the retention would be, under this example, 10,500 pesos, so he would be down 5,500, meaning that he'd get this loss until the tax is refunded. So the proposal also has been criticized because it doesn't really distinguish between types of companies. So you might have companies with very high sales and low margin models like electronics, retail resellers that are just basically picking up a small margin from selling on products. And they would be very vulnerable. Lower your margin, the more this would affect, as it's a withholding tax on sales. And then the concern is that it would potentially, because the tax effects would be so damaging, that it might push some of these smaller merchants that are on the marketplaces into informality, basically, I guess, selling goods on TikTok or on Instagram with DMs and not paying any tax at all. So that's the sort of the Mercado Libre argument. They've been the most vocal on this. Amazon, as far as I'm aware, is keeping a lower profile. Some of the other e-tailers aren't so much about marketplaces, so maybe the impact on them is a bit less. Now, the government perspective is that that Mexico has a big problem, which is lack of formality and lack of tax paying. And you've got to sort of, I guess, start somewhere. What they want to do is sort of level the playing field between physical and digital sellers and reduce tax evasion in this marketplace sector that's grown so much. And that, roughly speaking, 50% of Mexico's GDP is in the informal sector, and it's a huge drag on productivity, but also on overall tax revenues. And this is going to make things fairer. And probably, if you look at the goods on marketplaces, there are a lot of imported goods from Asia, small sellers, and it's quite possible that taxes aren't even being paid. If they're smuggled goods and stuff like that, import taxes aren't being paid. They're not paying VAT. So this is a way of catching that in a way that would be quite difficult to do otherwise. So it's a sort of least bad alternative. So that's sort of Eduardo where things are. There's quite a lot of noise. It might well be cut a bit, or it might be depending on the size of the company. But clearly, the government is cracking down on tax evasion, trying to push through measures that improve formality. But that, naturally is causing some concern that it's going to disproportionately affect some small sized companies from a cash flow perspective.
Yeah, I mean, I guess the government has measured the pros and cons, and they will probably collect, and they are in great need of tax revenue since Pemex is draining so much money out of Mexico's coffers. So I could see the government perspective. I could see Mercado Libre's perspective. I wonder how much this will push probably some of these marketplaces that have emerged at a fast rate, as you said, over the past years. How much this will hurt them and set Mexico back in terms of digitalization and heading back to the physical world as we used to know it before? It might not be that impact. The impact might not be that large, but yeah, the whole budget for next year has emphasized or has put in place different measures to increase tax collection. And I think the government is in desperate need to recover money, and this is one way of doing it.
Yeah, no, we've seen obviously which we've talked about before, the increase in tax on soft drinks, and which is also applying to electrolyte. We're seeing the big increase in tax on gaming, violent video games, and now we have this. I guess it's more of a kind of, given that it's a withholding tax, it's more of a retention issue. And then I don't know if you remember, Eduardo, but back a year ago now, or almost a year ago, they forced the Asian e-commerce players like Temu and Shein, which are the two biggest, obviously, to sort of register with the tax authorities and to charge VAT on the sales they make in Mexico. So there was a crackdown on them, and then in addition to that, there's been an increase in duties on Chinese imports. So as part of this budget.
Correct.
The government's going to potentially increase duties still further from 30 to 50% on Chinese goods. So there's an effort to crack down on low-cost Chinese imports. There's an effort to formalize the economy and therefore pick up taxes, and that's that's all to the benefit of the government, but it means the private sector is paying more money. And of course, a lot of people complain that the quality of government spending, whether it's the Dos Bocas refinery or the Mayan train, and the crisis of Pemex is sort of behind this desperate need for raising money. Now, it's a particular issue for Mercado Libre because it's Latin America's largest company, quoted in the stock market, by market cap at least. It's been doing, Mexico is after Brazil, its biggest market. It's doing very well. I was looking at some research. Apparently, its market share of overall Mexican e-commerce, has grown to about 38% from maybe 32% a year ago. So it's gained about 6 percentage points according to this survey by Sensor Tower. And meanwhile, Shein has seen its market share fall from 24 to 18. You've seen Temu's share down a little bit, Alibaba share, so the impact of most of their goods are sourced from China, I understand. So you're seeing Mercado Libre doing quite well, but with this announcement, if it goes through, you may see some negative impact. But it's interesting that according to this data, at least, Mercado Libre is now in Mexico about 3 times bigger than Amazon in terms of e-commerce market share. I'm sure there's different ways of doing the numbers, but that's it's quite a big leadership. Must be one of the few places in the world where Amazon lags the local player to such an extent.
Obviously, these government decisions always shake the ground of the players that will be impacted. Amazon will be as well, although I don't know how large their marketplace segment is. But one element that we should not forget to mention is also the government's effort to crack on smuggling fuel. That's the biggest probably place where they could collect billions of pesos if they do it properly, and maybe that's why they are being so upfront in cracking down on these operations. And there is an attempt even in the customs law to digitalize a few of the reporting and elements of those imports so that the government could probably get to know in advance when fuels are being smuggled into the country. So, all these issues reflect a need for cash.
And the crackdown on Huachico Fiscal, Eduardo, I think it's going really well. I was speaking to a large gasoline importer. He was telling me that their imports are maybe up 35% since the sort of crackdown began, whereas gasoline sales in Mexico are probably up 1 or 2% at most. So I would assume they and other importers are basically replacing the Huachico Fiscal, which has been blocked. And so I think quite a lot of credit needs to be given. It's obviously taken them a long time to get there, but at least it's being done now.
No doubt that it's huge amounts of money. There've been some figures revealed by opposition legislators, obviously, to reflect how large this criminal enterprise represented. But the government I don't know if it's true or not. It's all in the mix. But there is no question that the smuggling of fuel the Huachico Fiscal was really hurting Pemex and the government's tax collection efforts. So good for them. Moving on, Damien, you saw the news about Orbia and the potential sale of its Israeli subsidiary. It's not being confirmed, but what do you make out of that transaction? Is Natafim the company that might be unloaded?
Yeah, as you said, it's not confirmed. It's not. I guess it's not news. It appeared in an Israeli newspaper,
Correct.
a local Israeli newspaper, that Orbia had hired Evercore, the bank, to sell its precision agriculture subsidiary Netafim, according to the newspaper story, 1.3 to 1.5 billion. I think they paid about 1.4 billion for their 80% stake back in 2018. So if this is confirmed, and Orbia replied that it released to the stock market because its stock went up about 20% on this week on the news, on not on the news, on the rumors. They'd be coming out kind of even, which clearly the market, based on the stock market reaction, thinks is a good outcome. But from a investment return perspective, compared, it wouldn't be such a good outcome. I mean, in the sense that they're not getting any. If they sell it for 1.3 to 1.5 and they paid 1.4, they wouldn't be getting any kind of significant return on the capital tied up in this business over the last 7 years. I think it's. The Orbia is quite leveraged, and its debt to EBITDA is sort of 3 to 4 times. And this would, if this happens, their net debt to EBITDA ratio would fall from over 4 times, using IFRS accounting, to 3, to a little bit over 3.3. I read somewhere. So the Orbia stock, especially last year, this year it's done well. Last year was down 60%. I think it was one of the worst performing big caps in Mexico because of its leverage, and some of the different businesses weren't performing so well. So market would certainly like this. I mean, it would suggest a strategic kind of change or retreat to Orbia. I don't know if you remember, Eduardo, back in 2019, Orbia rebranded. It used to be called Mexichem, and then they kind of realized that they weren't Mexican, so the Mexichem didn't make a lot of sense. The sales from Mexico, I think now are 10 or 15%, and they weren't really chemicals either. So Orbia was meant to kind of represent, Orb would represented the globe, so it was like a global company, and then Bia was meant to represent, I guess, something, force or biology, kind of natural resources, and they became very, very sort of ESG friendly, and the purchase of Netafim kind of slightly reflected that, being an agricultural sort of irrigation related company based in Israel, and it was part of this sort of strategic shift we saw back in 2019 of Orbia, but now has been, if this happens, being slightly unwound, and I think there are, Orbia has been extremely successful over 10, 15 years, buying companies all over the world, but it maybe went too far in terms of the leverage that implied, and some of the diversification into less cash flow generating businesses. And I think probably other Mexican companies have also struggled a bit when they grow outside Mexico. Not in every case, but clearly Cemex, I guess, is the sort of poster child of companies that tripped up by growing too fast back in the 90s and 2000s. They paid a lot of money for Rinca. They were sort of bought assets all over the world, really, and they've been selling off their assets. They just sold some just recently in Panama. A few $100 million. They sold cement plants there. They've been sort of refocusing on 4 or 5 core markets, including the US and Mexico, of course, where most of their cash flow still comes from. And even quote unquote successful Mexican multinationals have had their initial hiccups when they expanded outside Mexico. As a group of Bimbo, it took a fair amount of time to achieve acceptable profitability in the US and Canada. Gruma also for years sort of struggled with profitability in the US and in Europe. So it's not that easy, obviously, growing outside Mexico, where these big Mexican companies tend to have very good margins. And and where regulations are different and so on. Orbia's case is a bit different because it was already a pretty global company. Petrochemicals, chemicals are also quite a global business. But I think the market's relieved that this experiment may be coming to an end in agriculture. It's been a challenge. It's been a challenging sector. So I don't think it's so much that Netafim has done poorly, but there's crop prices have been down, rain, climate change has been a problem for a lot of agricultural companies, and obviously it's quite a cyclical business. And then on top of that, like almost all petrochemical companies, they've been suffering from kind of cyclical downturn into PVC prices and other related chemical kind of issues that have affected companies like Braskem, that's struggling with its debt payments, and other chemicals out there.
Yeah, no doubt that Orbia has been in two sectors that have been struggling, and no company has 100% batting average in its foreign escapades. This is an unfortunate one. I was really excited when they announced the acquisition out of him, because obviously irrigation, saving water, climate change, it hit all the right buttons and as ESG proposition. But obviously companies need to not just be good to the planet, but they have to make a profit. And if it's reaffirmed and confirmed, probably they will do so when they present the results in a few weeks from now. It will show a retreat from that bet that Orbia took. I remember they changed the logo, and it was a very sophisticated logo, trying to reflect how their global presence had been growing. And yeah, companies take risks. Sometimes they work, sometimes they don't, and they need to retrieve sometimes from what it doesn't work. So this is, I think you described very well what are the circumstances under which they are taking this decision, and the market reacted as it should, and they saw it positively, agreeing with what you just said in terms of the agricultural sector being a tough sector to be in, and especially when they sell equipment or irrigation systems to agricultural companies that are not facing the best of times. So we'll wait and see.
Yeah, I mean, they have another asset that's become more interesting. They own 50% of Occidental Petroleum's ethylene cracker in Ingleside, Texas. The other 50% is owned by OxyChem, which in turn is owned by Occidental Petroleum. And Berkshire Hathaway, according to the Wall Street Journal, Warren Buffett's investment vehicle, is in talks to acquire the OxyChem unit. So Orbia, if it stays with its stake in the cracker, would be a sort of partner of Berkshire Hathaway. But there's sort of talk in the market that maybe OxyChem would be interested in taking out Orbia's stake for as much as a couple of $1 billion, and that would also be hugely positive, most likely to the equity value of Orbia. We don't know if they are interested in selling. We don't know if OxyChem is interested in buying, if they have the right to buy the stake. But the news around the Berkshire Hathaway interest has also propelled interest in what will happen to that strategic asset.
Moving forward, Damien, I saw that the size of the participation of the funds that foreigners have invested in the stock market declined again in September. Not the best of all signs, but probably they're taking some profits because the market has done so well this year. It's up nearly 24 to 25%, which is 10 points more than the S&P 500, and even 12 points more than the Dow Jones, and about 12% more than the Nasdaq index. But maybe this rise is giving some foreigners the chance to sell at a profit, take them back home. But this is a trend that is taking place. It's been like this for most of this year. In September, they withdrew 1.5 billion from the stock exchange here in Mexico to a total of 7.3 billion in 2025. Now their total foreign investment in the stock market is higher because obviously the valuation of the market is much higher. So these withdrawals do not reduce the percentage of the participation of foreigners in the market. But it's also an interesting snippet of information on how foreigners are also taking profits. Maybe, the markets have been a little bit on a rocky side over the past few days and weeks. So maybe this was the time to take some profits off. Some of the companies that have done extremely well so far this year have been the mining companies, obviously, because of gold prices reaching record highs, silver prices reaching record highs. So Peñoles has risen 200% this year, Fresnillo 270%, and even Grupo Mexico, which we have talked a lot in the past few podcasts because of its attempt to purchase Banamex and suffered a huge whack on its stock price. It's still up 50%. So I just wanted to highlight these changes in participation in the Mexican stock market as it's been outperforming many other exchanges in the world.
Yeah, I think part of that is the local pension funds are flush with so much money that they're buying more equities as well as other financial assets, which means that the foreigners are effectively selling to them. So the September data came in, and for the AFORES, which is, as you know, the name for the pension funds here, and their assets under management reached $420 billion, which is a 26% US dollar growth on last year.
Wow.
And in local currency, an 18% increase. It's about 25% of GDP now, which is an all-time high. Just a decade ago, the AFORES managed about 12% of GDP. So they've doubled in importance over a decade. The 400 plus billion is divided between local equities, which is a relatively small market, not very liquid. So if you're just keeping your percentage in local equities unchanged and you're getting more money, that's means that someone's got to be selling to you. So they're about 6.7% of local equities, 14% in foreign equities, mainly through ETFs, 8% in private equity funds. It's interesting that they have more in private equity funds than they have in the local Mexican stock market, and about 3% in FIBRAs, which are, as you know, the Mexican REITs. So, and that's just going to get bigger because, as you may remember, AMLO, probably one of the few reforms that the Wall Street and foreign investors and evil neoliberals applauded was the Social Security reform, which basically, from the beginning of the decade, raised the contribution to the Afore of a worker's salary from 6.5% to go all the way up to 15% by 2030s. And so basically every year it's going up. So the Afores are receiving an inflow of a higher percentage of salaries over that. So basically 8-year period. And at the same time, salaries are going up. So they're getting a higher percentage of higher salaries. And then because the markets have performed well, the value of those assets are higher. And that reform was applauded because had the contribution stayed at 6.5%, which is where it was originally, I think, the pension rate would have given people that are affiliated with the Afore, which is most private sector workers, would have been insufficient to sort of maintain their standard of living during their retirement. So by going up to 15%, you're going to be able to give people a retirement wage or a retirement income that's more similar to what their final salary was. It'll still be short of that, but anyway, this money is coming in. They also changed the regulations, at least, that when they invest in private equity fund, previously 10% of money invested in an international private equity fund, let's say with Apollo or KKR, whoever it might have been, 10% had to be invested in Mexico, either in growth equity or in private debt or in infrastructure or in energy. And they're basically raising that. It's been raised to 20%. So that means a lot more money will be freed up to invest in private equity in Mexico. But a lot of that private equity will end up going, I think, into infrastructure and energy, which are quite capital intensive and where money is desperately needed. They'll also, some of that through the equity private equity, the growth equity private equity will go into VC funds, which are very small as a percentage of total private equity. But as we're going to hear in the conversation with Bernardo, growing in importance, whether it's Cometa or High Ventures or De La Cap or Nazca, they're all investing in these fast-growing startups, so they're going to get some more money. And so the growth of the AFORES will make more capital available to areas of the Mexican economy that are not achieving enough or not attracting enough capital. It's not, and the sort of regulations have changed to make sure that a bit more of that money stays in Mexico. And I think the AFORES are probably quite happy with that change I wouldn't say quite happy, but were willing to sort of not that they had much of an option, but willing to accept that change from 10 to 20% as a way of ensuring that the government sort of stays committed to the AFORES system and to the separate private pension accounts. That obviously in other countries like Argentina, the government took over that money, and that's everyone's sort of big fear that the government will see this $450 billion and say, "I'd like that for myself." So they're sort of willing to make these concessions to keep the government on side and avert that sort of huge kind of fear that one day the government might try to take the money for itself.
Knock on wood that won't happen, and that the government, on the other hand, presents or allows projects in infrastructure and energy, which are hugely, hugely in demand. I mean, we were ahead, and Daniela Dib was ahead of the curve. I've been reading the Wall Street Journal on all the needs of data centers and AI on energy, and that they're even self-powering themselves in the United States, just like Daniela Dib reported on Microsoft. So there are great opportunities out there if the government sets up the conditions, puts up the table, ready for people to participate. I think a lot of people will be more than willing to enter those ventures. And I hope that the government realizes that doesn't go against any sovereignty risks. On the contrary, it will make even Mexico's sovereignty more independent and greater if you have a country that is growing at a faster pace with people making more money, earning more wages, and so on and so forth. But you need help. And ideology does not help you in those areas, I would suspect so. I think the AFORES have it.
That's right. And we saw an example that in the end, having gone through various iterations, the purchase of the Iberdrola, the first part of the Iberdrola assets that was sold to a Mexican private equity fund, MIP, financed by Mexican government entities initially. Then the AFORES came in. Then there was the IPO. Effectively, the AFORES swapped their position in the original structured deal for a public equity deal. And a large part of the money, therefore, for the purchase of the Iberdrola assets came from Mexico's big AFORES. So it's an example. I mean, there wasn't new electricity capacity added. It was basically financing the sale of Iberdrola to Mexican entities. But it's an example of the AFORES kind of playing a more strategic role, and I'm sure the government leaned on the AFORES as they do to participate in that deal, which is a deal very good for Mexico in the sense that you have these assets now in the hands of very competent managers and owners through the pension system. So I think we may well see more of these deals, but what's crucial is they're not just recycling existing assets, changing from foreign hands to Mexican hands, but actually financing new generation, for example, in the case of electricity, to meet this demand that we're going to get from data centers and just general industrial economic growth.
Yeah, you know better than anyone, Damien, that in terms of creativity, financial institutions could be very creative, and the government needs to regulate them. I'm not saying that there shouldn't be oversight or they shouldn't be left alone. They need to be supervised, but creativity is one of Wall Street's and investment bankers' greatest assets. So, and like you said, we need it for new power generating infrastructure, transmission infrastructure, distribution infrastructure, roads and railroads and ports and everything else. So it's just a matter of letting the genie out of the bottle in a creative way so that you control the genie and the genie doesn't control you. But I think we could be there very quickly if the government is creative enough.
Eduardo, I don't know if you saw the news out on Thursday. Mexico's Plata card, the credit card fintech, raised another $250 million at a reported $3.1 billion valuation.
I did not see it, but that's a hell of a lot of money and a hell of a valuation. What do you make out of it?
Well, it's interesting because, as you probably remember, Plata got its first stage of its banking license December 2024. So they are going to be ready to, apparently, according to the story in Bloomberg, going to have their bank operating quite soon, maybe end of this year, beginning of next year, I would guess. And there's also been press reports about them expanding into Colombia. So clearly, the valuation is reflecting being a full-serviced, full-fledged bank in Mexico, and then maybe in other countries, starting with Colombia. So right now, the main only kind of visible product is Plata Card. It's very visible. They've done a brilliant job in executing it. There's more than 1 million Plata Cards out there. If you look at the sort of digital downloads of apps and website traffic and stuff like that, Plata is basically just behind Nu and Mercado Pago, but it's significantly outperformed some of the other fintech like Story and Klar and Voila, and even though it started later than them, so the investors are betting on that. My guess, I don't have any additional information than what's in the Bloomberg story, but they talked about 3 investors: Cora, More Strategic Ventures, and Televisa Univision. Televisa Univision, I would guess, it doesn't have a very strong balance sheet itself. It would be entirely media for equity. They have also deals with Voila in media for equity, as long as with a lot of other startups. So maybe that 160 million isn't all cash. Presumably, Cora and More Strategic, it's cash, but they're not the sort of, let's say, the top tier VC funds in the US. So we'd have to look into more detail if they have any kind of liquidity rights. In the past, when I talked about their previous fundraise on this podcast, I speculated that there might be some sort of strings attached to the investment, and I was informed by the company that it was pure equity. There were no strings attached. So maybe it's the same this time around, with a possible exception of the Televisa Univision being non-equity. But that again is speculation, to be clear. But it's To give you an example, Eduardo, Ban Bajío, which is, it's quoted in the stock market, it's a mature bank. It had profits last 12 months, about $500 million, is valued at less than about $3 billion, a little bit less than Plata. So this bank that's been around, has got a very strong presence in the center of Mexico, in the Bajío, makes $500 million a year, is being valued at less than, it's only being valued at 6 times earnings because it's very sensitive to declining rates. It's being valued at less than Plata. I mean, Plata's really interesting company. It's founded by a group of people, including the CEO, Neri Dolardo, who's Italian, but who spent some of his childhood in Russia. He worked at Tinkoff Bank, and then he and Oleg Tinkov left Russia at the time of the Ukrainian invasion. We talked about in a previous podcast, and found Mexico was the market was most attractive, and they brought a lot of the Tinkoff know-how to Mexico, and it's been very successful. They've created, at least according to the VC funds, $3 billion of equity value. I don't know how much money, total invested money, there's been, so I don't know what the sort of the multiple of invested capital, that 3.1 billion, but obviously they put in 3 billion, so it's definitely a positive multiple. They are basically going to be competing, against Nu, most obviously, which is also getting its bank license, and then Klar, which, as we talked about in a previous podcast, raised in a Series C, I think $190 million, led by GA, General Atlantic, 170 equity and 20 in venture debt. They had a valuation of 800 million. So Plata is valuing itself, at a 4 times multiple to Klar, which is interesting in and of itself. And they're going to be going head to head. And then, of course, you have Voila, which also raised a bunch of money and is already very successful in Argentina, although it's far, far less successful in Mexico so far if you measure success by number of clients and market penetration.
No, it's another news that continues to reinforce the view that the fintech world is attracting money left and right. I mean, this banking license element that they mention, they do say that they will be offering some new debt services and payroll services. So the competition will be heating up. We wonder whether the valuations will sustain, or whether the company will be able to sustain those valuations in the long term. Plata, like you said, I mean, I don't know the company that well, but I was very impressed of how aggressive they were earlier this year and in 2024 of penetrating the market with very cleverly put together ads on platforms and the digital world, where they offer this card that it came in a beautiful package and it gave you 60 days to pay off your debt rather than 30. So they were creative and innovative. So I wonder, I mean, it seems like that this is paying off with them in terms of raising capital and bringing their valuation to up to $3 billion. Very, very impressive.
Yeah, now Nu is worth 70 billion, so 3 billion is tiny compared to Nu's market cap. So the bet, is that Plata will be another Nu, maybe half the size. Maybe it's not going to go into Brazil, but if you get it right, the returns can be extraordinary, as Nu has shown. It's now profitable in Brazil, so that's the bet. The difference is that Nu started in Brazil more than a decade ago, and kind of to some extent had the digital space to itself for a while. Whereas here in Mexico, you have this very fierce competition from Nu itself, from Klar, from Story, from Voila, and Mercado Pago, and then you have all the incumbent banks in different degrees have done a good job digitalizing themselves and shedding some of their kind of legacy costs and legacy assets as they've done it. So, it would probably be a mistake to think that what you were able to achieve in Brazil 10 years ago, you could achieve in Mexico today. But clearly proved that that you could turn $5 billion of equity raised into 70 billion market cap. So that's what the VC funds are betting on.
I mean, yeah, no, probably it's a very high standard to try to imitate or reach, but for an investor that enters at a right level and exits at the right level, this will be a very profitable bet. So still time and see which ones survive, which ones match up what they are expected to achieve, and which ones fall overboard. I mean, this is a wild world we live in, and maybe not all of them will survive.
Well, I think that's it, Eduardo. Do you have anything else?
No, let's move to our interviews.
This week on Mex Moves, we're joined by Bernardo Cordero. How are you, Bernardo?
Good, thank you very much.
So Bernardo is a partner at Nascent, a venture capital fund here in Mexico City that backs high growth companies across Latin America. And he's also the co-founder of Mexico Tech Week, the festival that every October transforms Mexico City into a kind of center of innovation in the region. And next week is Mexico Tech Week, and there's going to be hundreds of independently organized events, panels, workshops, meetups, demo days, parties, restaurants, you name it, all over the city to sort of discuss technology, startups, VC, and a lot more. It's a bit like the Maco Art Fair, but for wannabe tech bros. More money, perhaps less good looks. So, Bernardo, tell us a little bit about Mexico Tech Week. How did it come about? What inspired you and your fellow partners to create it, and how has it evolved or changed since the first edition?
Yeah, for sure. So we didn't invent the concept of Tech Week, right? There's several events that happen similar to this in the US, whether it's San Francisco, New York, etc. And we had been as entrepreneurs to a few of these. And after going to a few of these, we had definitely gained a lot by being there. But my conclusion after visiting some of these cities and some of these events was, if we really want to have this value as a community, because a lot of the founders from Mexico would go to these events as well. If we really wanted to obtain that value and to create value, we needed to create those same ecosystems in Mexico, right? And there wasn't one event in Mexico that really brought the community together. And that not only brought the community together, but brought people from outside of Mexico to see what was being built in the country. And we've seen how tech has grown over the years. Now, I started in tech in 2012 in Mexico, from basically going from zero to what it is today. But we hadn't seen the ecosystem grow and together in unison, et cetera, where everybody could really help each other grow the way it should be. So we did a test in 2003. To be honest, we had no idea if it would work. Literally, the event started with a LinkedIn post. So talked to Victor, one of my partners at Nascent, and said, "Hey, maybe we should put this thing together." As usual, he came back with, "You're insane. There's no way we have the time or we're going to be able to put this together." But on the other end, he said, "Well, let's try. Let's put it up somewhere and see what happens, and we'll see where it takes us." So I put up a post on LinkedIn, kind of summer of 2023. And the reception by the community was amazing. All of a sudden we had messages from entrepreneurs saying, "Hey, this is really cool. How do I help?" Or we had messages for maybe potential sponsors that say, "Hey, how can we get involved?" Or from investors and VCs that said, "Hey, this would be a huge help to the ecosystem. How can we do our part?" So 2003 came together, and all of a sudden we had 80 events. that came together in just a few months. We had about 3,000 people that attended the different events, and this from something that started from nothing for us. It was amazing. It was one of those things where you talk a lot about product market fit in startups, and we instantly saw it with Mexico Tech Week. And just to finish on the answer, I think the most important part of it was the way the events come together. It's decentralized, right? So it was us creating the vision, creating the brand, putting out what we thought the event meant. But at the end of the day, it was these 80 hosts or 80 different entrepreneurs or VCs, et cetera, that came together and created their own events within the week. And that's what allowed the event to really take off in 2023.
Bernardo, so it's quite interesting how it has evolved. How does it compete, or doesn't it, with other tech weeks in other places? I assume San Francisco was probably the original tech week. And have you become like a Latin American tech week, or is it just Mexico that you highlight during that week?
So we don't compete. No, at the end of the day, every city or every country has its ecosystem. No, what we're highlighting in Mexico Tech Week is the technology and the startups that are coming up and are being created in the country. So for us, we started it in Mexico City, not just to highlight what's happening in our city, but to highlight in general what's happening in the country. And that's our focus. That's our focus today. We believe there's so much going on all different fronts. There's a lot to showcase. So that's our focus today, focusing on Mexico as a country from the perspective of everything that's going on in Mexico City, which has become impressively vibrant over the last several years in terms of what's happening in the ecosystem, in terms of startups and investment, et cetera.
All companies come. I mean, I'm sure it's not just fintechs, but it's all over the ecosystem. What sort of sectors do you have seen evolve over the years?
It's all over the ecosystem. No, I mean, this year I talked about the size of the first event we did in 2023. This year is crazy. No, we went from those 80 events we had in 2023. This year, we just reached over 400 events that are going to happen during the week. We believe there will be. We're looking at numbers now. We believe there's going to be at least 15,000 people, if not much more. So it's an event that's growing a ton. In that. The reason it's growing so much is because there's so many verticals that are represented, right? I mean, we see for sure the fintechs that have been a big part of the ecosystem over the last several years, but we see it across e-commerce, we see it across health tech, we see prop techs, obviously AI, not only in its own right, but across all these industries. So they're really every industry that is being changed by technology is being represented. We see anywhere from small startups to big tech companies that also participate. No, so the Googles of the world, the Amazons, AWS, all of those are participating in a way as well. No, so it's also this combination of a sector going from those that have been in the sector for a long time and have already been successful and already grown to these huge companies, to those that are just getting started and see a lot of those companies as kind of the vision of where they want to get to at some point.
And how much attention are you grabbing from people abroad? I mean, are they entrepreneurs coming to Mexico, or more than entrepreneurs, VCs that are coming to Mexico?
Yeah, so I think that is something that's evolved. No, I'd say edition number one in 2023, it was very local. We had the top VCs, but it was the top local VCs. No, we had all the top entrepreneurs, but it was the local entrepreneurs, and that we continue to have that in 2025. But the difference that we're seeing is we do get many more international visitors. No, first, obviously, all those visitors from Latin America. No, they're coming. We get a ton of people coming from different countries in Latin America. And then from other parts, more than entrepreneurs, for example, from the US, we get investors that are coming to see what's happening here. So we start to have that combination of going from a local event, local ecosystem, to something that is now combining the ecosystem with people from outside really interested in seeing what's happening here.
Now I might ask you a trick question. With technology allowing us to connect, not necessarily physically together, but from abroad, I guess people like to be together still and network face to face. Am I right, or what's your sense on that front?
It's interesting because there are many events that have applied to try to do virtual events. Up until today, our philosophy and our vision has been this is an in-person event, and we have not allowed those virtual events within Mexico Tech Week, which, as you say, it's pretty interesting. That's not necessarily going to be the vision forever, but that's how we've handled it today. Because we started in 2023, we weren't that far off from COVID and from everything that would happened, where people for sure were looking for much more engagement, for that integration within the community. So for us, it has been very, very important to create this setting where people can be in person. And obviously, there's a lot of tech that goes around it in the event, etc. But that's been the vision till today. We'll see how that evolves in the future. I'm sure that there's a space to see how we can combine that vision at some point. But yeah, I think the essence of the event today has been how do we get people together in one setting and really talk about the future of technology in the country.
Well, Bernardo, and you have a great setting in Mexico City, which has become a very desirable place to visit. So good luck.
Yeah, no, thank you. And I think that's one of the interesting things about it. No, I mean, it's for sure we're celebrating the startups. For sure, we're celebrating the companies and the entrepreneurs, etc. But the setting is a big part of it. No, Ciudad de Mexico, Mexico City is a big part of the event. No, the events, these 400 events happen in almost 400 different places. No, so you're really able to get within the city. You're able to understand the cultural aspect of what's being built within where it's being built, which I think it's very interesting. No, and it was one of the big learnings from when we were going to San Francisco, New York, some of these events. We would talk about our companies, but they weren't understanding the cultural aspect of it. They weren't seeing what was really happening on the ground. So that's a big part of why, going back to the previous question, this combination of being here, being in person, seeing how these products are being lived in the country, and specifically within Mexico City during the event, it's very key to the experience.
Well, like I said, good luck, Bernardo. Thanks for the time you've given us. All the best. And we hope this tradition that you've started will continue and go even further.
No, thanks so much for your time. Looking forward to seeing everyone at Tech Week. Best way to participate, literally go to the site, mexicotechweek.mx, and you can see all the events there registered directly on the site.
Great.
With us today, Pedro Latapi. Pedro is the CEO of HR Ratings, Mexico's largest credit ratings agency, and the first in Latin America to be recognized both by the SEC and the European equivalent, the ESMA. And under his stewardship, HR Ratings has grown from a domestic player, the largest in Mexico in terms of number of credits rated and evaluated, to expanding into the US, where it's rating structured products, private credit, and so on. Pedro, thank you very much for joining us.
No, thank you, Damian. Thank you, Eduardo. Happy to be here.
Pedro, why don't we start off just a brief description of HR Ratings, because some of our listeners may not be that familiar with the details of your operations. How big are you? How many credits are you rating? How does your business model work?
Sure. So yeah, I'll give you a very general context of HR Ratings. So as you said, we're a rating agency. We're the largest currently in Mexico. We started out as a Mexican entity in 2007, 2008. It took us a couple of years to reach where we are right now in market share. But we do in any given year, we do between 2,400, 2,500 ratings per year. So we have that amount of ratings that we issue, surveil, monitor, and do the process that involves getting each rating as accurately and as quickly as possible. We have 140 people in the team. We currently have the office as well. Our headquarters is still here in Mexico City, but we also have a Miami office that we've been growing for the last 3-4 years. We've been really growing in the US and sort of expanding our our operation over there. And just to end with a very general context, we're a full rating agency, so this means we cover every type of asset that there is. So we do a risk analysis on something from municipalities, obviously sovereign debt, which is a very, very important subject in our operation. We do states, we do banks, non-bank banks, corporates, toll road projects, highways. So everything that needs a risk to be understood or that needs to be analyzed from a risk perspective, so that to understand if it can pay the debt or if it has really the cash flow to pay the debt, that is something that we can rate.
And what sets you apart from S&P or Fitch or Moody's? What is your way of rating credit different? Is it just that you focus on Mexico and now the...
I would say, HR ratings started in 2007, 2008. So, it can be, it sort of feels like ancient history right now, but it's really, if you remember, it was when it started and the peak of the financial crisis, of the great financial crisis. And if we remember more from that, it was a moment in which rating agencies were really singled out as one of the main contributors to the crisis. And why? Because some of them didn't do the work, some of them just took for granted that everything was AAA. So I would say that HR ratings started out as really with no margin for error. And that has really brought us into doing things the right way. And when you say in a rating agency, doing things the right way, it really sounds very general. But if you say in a rating agency, what is doing things the right way, is being very open and very transparent about everything you do. For example, in the past, there were no open methodologies. Everyone sort of had like their secret sauce to do ratings and to understand ratings. And no one really told you what they thought or what they felt was a risk factor. HR ratings from the start, it has always had a very open and transparent methodology. So every part of the methodology is open in our webpage. Every part of the rating process is open on our webpage. And another thing that is also something that should be normal but wasn't really normal, and it's still not normal, we do a full rating report for every analysis that we do, every annual review, every initial review. So everything that we do, we always do the full work and we do it in a completely transparent way. So I would say, once you start telling it, and I always say this, once I say it, it sounds very, very easy. And it sounds very like that's how rating agencies should operate. But that's not really the norm. And I think that's what really has set us apart, because it really translates into a good quality service for the entities that we rate and for the investors that use the ratings.
You mentioned, Pedro, the importance of the sovereign rating. In Mexico, the sovereign has just recently bailed out again Pemex with these PCAP securities, plus in addition to that, buying back Pemex debt, in addition to that, making significant equity contributions to Pemex. And that's led to ratings upgrades of Pemex, but it's also made people very much more concerned about the sovereign risk. I've read that some agencies, some economists rather, looking at Mexico debt approaching sort of 57, 58% Mexico government debt of GDP from under 50 a few years back. Are you concerned that this bailout of Pemex is going to undermine the sovereign ratings?
Yeah, I think this is a really interesting point, Damien, because and why do I say this? When we started doing the sovereign rating for Mexico, which was, I would say, probably 14, 15 years ago, we also did the rating on Pemex. And why did we do this? Because we really didn't see any scenario where you could have a standalone Pemex operation without considering, or a standalone Pemex operation and really not considering it as part of the sovereign debt or not including it as part of the sovereign rating. So we've always had the vision that the net debt of the Mexican government needs to include the Pemex debt. This was, right now it appears also to be the norm in rating agencies, and everyone's saying, "Oh yeah, like we're going to equalize the ratings and say that the sovereign debt is the same as the Pemex debt." But this hasn't really been the norm for the last 10 years. We started seeing from other rating agencies that you would have a very low rating for Pemex and a higher rating for Mexico, which really, like I would say, we had a lot of discussions with investors where we really didn't see that in a case of any default from Pemex, the government would still be able to issue debt as a triple B. So going back to our analysis, we've never seen it separate. We still see one dependent on the other. The Mexican government debt that we currently have is between 52-53% of net debt to GDP. And this also includes the Pemex debt. We've never separated the Pemex debt. What has happened, I would say, in the last year, really, we really haven't seen it. I mean, even with the situation that Pemex is going through, we haven't seen any deterioration in this ratio, which is really the main ratio that we consider and that we see, and that really ties up everything that we see in the sovereign. So to be more clear, I would say the Pemex situation is not new. The Pemex situation is not something that is changing or that there's more risk because of what the sovereign has done with the Pemex debt. We continue seeing it as a whole. We continue seeing it as one. And we really haven't seen any deterioration in the last year of that entity as a whole.
Pedro, in that sense, your methodology then differs with some of the other ratings agencies that give one rating to Pemex with government support or without government support. Am I right to say that?
Yeah, very, very right. And this is something that, I mean, we've been, I would say, we've been having to explain this for the last 10 years. It's really interesting that right now, everyone, like you're seeing even upgrades from other rating agencies to the same rating as a sovereign, but this is the same rating that we've had in the last 10 years. It hasn't really, we've never seen the two entities as separate. There's no for that.
If I recall correctly, you put Mexico on negative outlook in November of last year. You must be close to issuing a full review. I know you won't tell us what will that be because it would give us some privileged information, but is it coming close? Is there a schedule that we could look forward?
No, we really don't have a schedule or a specific date. We do review our ratings on an annual basis. That's the best schedule you could probably get. But yeah, we review on the annual basis, and we also review once we have all of the elements. That I would say one of the main elements, for example, in the sovereign, is the budget for next year, which is something that has already come out. So I would expect the team, the team will probably conclude and do the annual monitoring as we do for all of the ratings.
And now, if I might go back a little bit to the beginning of the conversation where you talk about HR rating, how it all came about, you mentioned that the financial crisis was a turning point or a flexible point in the sense that trust for the rating agencies declined because of concerns that they were too lenient with the ratings and probably some of the subprime bonds. And also, do you feel that opening has been overcome and that lack of trust has been overcome in the whole industry? And how do you think HR is perceived in the marketplace in terms of its capacities and rating fundamentals?
Sure, yeah. I would say it was a much harder environment to be a rating agency during the 2010s, 2015s than right now. I think everyone is coming back to the idea that rating agencies as a whole are a very good provider of information to the markets. And that's really our function. Our function is, how do we provide information to the markets to make a more informed opinion? And you see it daily. Like, I mean, I would say every time you open any newspaper, any given day, there's an analysis from one rating agency about whatever you want. But I mean, there's always information, because rating agencies are very good providers of information, and markets always need more information. So yeah, I would say we've changed in the perception of rating agencies as being the enablers of some of the bad practices in the 2007-2008 crisis, to right now being more of information givers. And I think that's one of the conversations that we've seen evolved. And specifically talking about HR ratings, I would say and something that entities and investors always have recognized is, we try to do it's not that we try. We do the work on each and every rating that we do. Some of them don't like it, because they say, oh, your reports are 40 pages long, 30 pages long. So it's a lot to review. It's a lot to assess. But I think that's something that really separates us from other agencies. We do the work, we do the due diligence. We're not the fastest in the market, and we're very open about that. We're not going to give you a rating in 1 week, 2 weeks. And if you want the fastest rating agency, we're not going to be that rating agency. But we're going to be the rating agency that really does the work, that really goes into the deep dive. And I think that shows in the work that we'll be able to provide for every entity that we rate.
Let me ask you a question. Maybe we as journalists should be looking at this, but do you look back at how you did, and what's your batting average ratio, if I may use a baseball comparison, on how?
I mean, we do look back, and here I would say there's and I've been involved in a lot of conversation about this, because as a rating agency, you do look back. And I mean, I can tell you the regulatory look back reviews that we do on a yearly basis, where we say how good or how bad our ratings were. And we do that. It's a process that we do for every asset class, in which we try to understand if there's any change to the methodologies that we need to do, or any change to the approach. That's part, but I would say that's part of the regulatory process. But the deeper dive in the rating agency environment is, when you look back, how do you assess if you were right or wrong? Right? Because I mean, it's very easy to say, if I had a AAA that went into a default in 1 year later, I can say, okay, I was bad. Like, that was a bad hit, or that was a miss from my part. But if it's a AAA from 1 year and it's still a AAA 5 years from today, was that a hit? Like, does it count as a hit for me? Is that like, so it's a more, I would say that's, I've been involved in very, very philosophical questions around that, because yeah, you can say that rating agencies, when you don't see a AAA going to the D, yeah, it's a very direct miss. But if you 5 years, 10 years from now, a triple B is now an A, or is a double A. Was I correct? Was I incorrect? So yeah. I mean, to answer your question, yeah, we do look back every year, but we also try to understand if in the long run we're doing things the right way, if our methodologies are approaching the right way, because the right way is if we were below what was expected or above what was expected.
So Pedro, what would be the lessons from the Unifin, Credito Real, Tangelo, and so on failures for you? What are you doing differently since then, if you're doing anything differently?
Sure. Yeah, I think, I mean, and obviously hindsight is always 2020, right? But every crisis or every change in every sector industry needs to change something in your operation as a rating agency. Why? Because there was something that you were probably not understanding as you needed it to be understood. There was something that changed that you didn't realize at that moment. But to be more specific in that, for example, the lessons learned in that particular moment or from that particular sector were two lessons, I would say. The first is the value of the structured finance products. Why? Because even with everything that happened with the non-bank financial institutions, and even with them being very different in terms of asset classes, one was a leasing agency, the other was payroll discount. So even with them being very different, the structured finance products and the structured finance set that they had, it all became very, very good compared to what was expected. So I would say the first lesson is, okay, we had a product that really hadn't been proved in the same way in the past. And we saw that even with what was happening with the entities, the structured finance products really paid as they were expected to pay. So I think that was the first lesson, because there was some concern, I would say, in general in the industry, that the structured finance was not going to behave as a separate entity or in a separate way as the entities were going to behave. So I think we all realize the value in the structured finance and the value of the products directly. The second lesson would be more in the in the corporates part. And I say in the corporates part, why? Because if you saw all of the financials from the entities right before they all started going into or they all started showing problems, there wasn't really a lot of I would say red flags or even yellow flags in the financials, in the financial analysis. So really the lesson here would be more, we need to understand that, the financials are going to be there, or the financials are going to tell us something. So secondly, on the corporate level, the lesson was, how do we understand that, the financials the financial statements of the company are going to give us something or are going to tell us something, but how do we tie up this to more data that is not really available in the financials of the company? And with this, I mean, how do we get, for example, bank statements? How do we get the non-structured sources of information, compare them with the financial statements, and try to understand more of how the company is behaving? This is because why? Because even the rating agencies in general are very much structured and lean towards basing the analysis on traditional financial statements that we get readily available. I would say the lesson is, how do we try to compare this more with other types of information or other sources of information, and try to understand the company better through this new type of analysis.
Pedro, I'm changing a little bit on the review and on your performance. How has it been for HR to penetrate the US market? I assume it's a very competitive industry there, as it is in Mexico, but probably much, much tougher since Mexico is your home. You have a home field advantage, let's put it that way.
I would say it's been an interesting, very interesting ride. Obviously, right now we're seeing that we can add value in the same way that we did it in Mexico. So understanding where we could add value, the way in which we could add value through a full, transparent, complete analysis. We're seeing the same in the US market, specifically in private credit and private debt. Right now, our operation is very, very present in that arena. Obviously, private credit and private debt as a whole in the US are expanding and are growing dramatically. And there's a need for, again, a very good, normal, quality service from a rating agency that can provide the same value. So I would say that's really where we're focusing right now. We have a local presence now in the US, which is something that you really need to expand the operations. We're trying to really understand where else we can add value. We just published our first regional banks reports, which is, again, it's a sector that is not really covered by the big competitors. The smaller competitors, I would say the approaches can vary, and they're not. I wouldn't say they're really covering them well. So I think that's something that we could add value, and that's something that we will continue to assess and continue to look for opportunities over there.
So is there a learning curve in terms of accounting differences between the two nations, or you were talking about structured debt before. I'm sure the markets are always improvising, inventing new things to create asset classes, and that puts you have to be running behind, or probably not necessarily running way behind, but trying to catch up. What can you tell us about that in specific in the US?
Sure. I would say the US market, it's a very innovative market in terms of the approaches, in terms of what we see. I wouldn't say really that there's a fundamental change in what we see. At the end of the day, corporates, plain vanilla corporates in Mexico, plain vanilla corporates in the US, the accounting is really the same. Banks, we did need to just change the terms or the terminology in the methodologies, because, for example, banks, they use different terminology. Public finance the same. You do need a different approach or a tweaked approach to understand them. But I would say the very plain vanilla things that we see in the US are very much comparable to what we see in Mexico. Where we do need to really focus on how to understand or how to analyze is, for example, where new asset classes are rated. I would say we've been approached even for very interesting new asset classes such as crypto, which really don't tie up to our methodologies. And sometimes there's ways in which we can approach them. But I would say, as rating agencies in general, we're always trying to understand how the market is changing. But we need to. I would say we're much more on the cautious and on the slower side of innovation, because we sometimes see things that are really not something that we can understand from a depth perspective, or a very fundamental perspective that we still manage.
Well, Pedro, fascinating, really. It's a very interesting industry. Sometimes I'm sure not very gratifying for you guys, but it's still something that needs to be done. And as you said, you're incredible providers of information to the market. So you're a key player. And hopefully we can continue speaking to you to learn more about what you do, how you do it, and how you're doing.
Yeah, thank you. Thank you, Eduardo. Thank you, Damian, for the invite, and happy to continue the conversation.
Thank you, Pedro.
Well, thank you very much for joining Mex Moves this week. Encourage you to rate the podcast, and please subscribe and listen next week if you can.